how to buy your first rental property in your 20s. I'm going to go through the strategy that I wish I did. Just to give you a little clarification, I have 15 rental units now. I flipped over 50 houses and I've sold over 150 houses. So if you want to buy a rental property in your 20s, this is what you should do. First of all, this sounds really cheesy, but you need to realize your values and why you want this. You have to get really, really clear on your values and your expectations, because rental properties are not what the majority of people think they are. If you already do have credit cards, you want to keep those accounts open. Just keep the balance at 30% of your utilization rate or less. So I wouldn't even recommend getting credit cards. I would recommend staying away from every credit card, but a secured card. A secured credit card is the way to go for building your credit and also for kind of managing your credit. A secured credit card is basically when you take $200, $250, $500 and send it in to one of the credit card companies like Chase or Capital One or USAA or something like that. And they send you back a credit card with that amount that you sent in on it. And then every month you just use it for like a tank of gas or something like that and put 30 bucks on it, 50 bucks on it. And you keep it under a 30% utilization ratio, because when mortgage brokers are looking at you, they're going to want to see that. Because one of the big things when a mortgage broker pulls your credit is they look at your length of credit history. So if they see 2 years or something like that of you every month making that payment of borrowing a little, paying a little, borrowing a little, paying a little, and not going over your 50% ratio, that's why it's best to keep it at 30% of your balance that you can use. Keep it at 30% of that. Then the mortgage broker will give you more favorable terms and maybe even approve you. Sometimes they will not approve you if you don't have enough credit history. And number two, you want 2 to 3 sources of revolving credit. And it goes counterintuitive to like personal finance responsibility. You should take on credit, but you do need 2 to 3 lines of revolving credit for mortgage companies to give you more favorable rates. If you are self-employed, if you're doing a side hustle and want to try to get like your first rental property or something like that, you're going to need 2 years of LLC or S Corp or corporation of 1099 income. So what that means is, like, since I have a business, the IRS and mortgage companies will not give you any credit for that business unless you have 2 years of tax returns on it. Let's just say I'm 25 and I start a business. I would need 2 full tax years before I'm able to use that income as eligibility to get a mortgage. Now, I've only gotten a mortgage based off my 1099 income. If you want to not wait those 2 years, the tip with that would be to get a W-2 job, which is basically just like a job. It would have to be enough that you have a DTI, a debt to income ratio, that is, every mortgage lender is different, but let's just say 35 to 40%, which that means is your debts, like your outgoing per month is 35 to 40% of your incoming a month. So if you want to qualify for a house to make it a rental property and the house is going to cost you $700 a month, you're going to need a W-2 job that shows that you make 7, 14, 28, at least $2,800 a month. So that's really, really important. Sometimes people can do that at a job like Starbucks or Target or something like that. But if you want to fast track this process, you're going to need that W-2 income. This is all about if you're getting a mortgage. Now, you could buy something in all cash, and that is a whole different amount of strategies, or you could buy something with seller financing, which is a whole different strategy. If you want to do a seller financing type strategy, you should do this. You should do direct mail, work with wholesalers, or cold call or door knock yourself. So direct mail would be expensive and you'll need some money to get started with that, and you'll need some time because that is one of the slowest sales cycles in real estate, and you have to make sure you have the right lists of people that you're targeting so you don't waste your money, because it's very expensive versus other lead generation sources. That was always a little too slow for me. So if I was looking for a deal or something like that, I would find the neighborhood that I'm interested in. I would gather their numbers and their software to do that. You can ask me or email me and I'll tell you what it is. And you gather the numbers of the neighborhood you're looking for. You load them up into a dialer like a Mojo dialer or something like that. Just put your headset on or sit there with your phone and hit go, and the Mojo dialer calls them, and you just talk to every single person you can and ask them if they want to sell their house. I would think any off-market thing I bought was probably about 30 hours of time to find the deal. Go to mycreditreport.com or mycreditfreereport.com or something like that. I'll link it in the bio. and pull your credit score. You'll get 3 scores. It'll be Equifax, TransUnion, and Experian. And so what mortgage brokers do, they take the highest, throw it out, take the lowest, throw it out, and they keep the middle. That is your qualifying score. Now you only need to have a 580 for the strategy that we want to do, and that's the lowest that you're really going to have. But that is kind of an exception. You're going to be paying a lot of money that you don't need to pay. So if you can get it to a 620, you're golden. Higher is good. If you get it to a 700 or 720, that's amazing too. But anything above like a 750, it's not going to be exponentially money saving. So the real sweet spot where you really see a lot of difference in the amount of money that you will pay on a mortgage is from 620 to 720. So just get to 620 if you want to just get there. You can have a co-signer, like a parent or a friend or something like that, that will co-sign on this mortgage for you that would help you qualify. But the co-signer does not erase bad credit. It can help you on your DTI, but it does not erase bad credit. Then you're going to go to your mortgage broker. You're going to go to I would Google your city and Google mortgage brokers and see who has the best reviews. From there, I would call a couple and meet with them. And I would also call credit unions and small banks in your town. Ask them if you can qualify for an FHA loan. And an FHA loan is like a first-time home buying loan. It's not exclusively for first-time home buyers, but the majority of people that use it are first-time home buyers. The bad part of the FHA is that you will be paying property mortgage insurance, PMI, on that mortgage. So you'll be paying an extra couple $100 a month for your PMI, which is property mortgage insurance, which is just saying that you're a new home buyer. They are making you pay a little more money to compensate them for the risk that they're taking on you. But what's a good thing about the FHA loan is that you only have to put down 3.5%. So if you put down 3.5% on $100,000, that's $3,500. So that's the lowest that you're gonna ever find to put down on a mortgage. Lots of mortgages are 10%, 15%, 20%, 5% even, but your FHA is gonna be the lowest. Now, as you can see, the lowest, but you are paying more monthly. But after a year or so, you can refinance out of that and drop your PMI and pay a reduced rate per month. Another great thing about an FHA loan is that you can buy a multifamily house for it. So I recommend everyone starting, buy a multifamily house. So if you're looking around at something to buy, I would buy a duplex or quadplex, a 4, or a triplex, a 3.